I'm Matt Bichard here in Dallas for NAREIT's REIT World 2017. Joining me today is Glenn Rafrano, the CEO of VEREIT. Glenn, thanks so much for joining us today.
Well, thank you for having me.
Now, when you took over at VEREIT in 2015, you had some obvious challenges to overcome, and you laid out a very clear plan for changing the company's culture and direction. So as you look at the company now, how do you feel that the past issues of the company have been addressed, and where does VEREIT go from here?
Well, we did lay out a plan. It was August of 2015, and it was a fairly detailed plan. We've done a really good job on that. We had some I'm calling legacy issues. For instance, we had 9 material weaknesses. We've taken care of all that. We had the portfolio was good, but we had some trimming and diversification. We sold $3.1 billion of assets over the last 2 years, and in a very productive way, and a profitable way. We feel very good about that. Our debt was high. We had $10.5 billion. It's down to $6. Our net debt to EBITDA was 7.5. It's now 5.5. We have a 2.3 revolving line of credit, almost fully drawn when I got here, 0 drawn. So the debt our debt capacity is good, and our safety has really been built into the balance sheet. Coal, which was an investment arm of ours, a very important asset, and our goal was to reestablish its brand. It unfortunately got hurt during the 2014 era and lost many of its broker-dealer relationships. We gained many of those back. It became a valuable asset to us, but strategically, long-term, not necessarily good for our business. Just this week, we announced a sale of coal to a very good institutional real estate firm, CIM. It will help complete a lot of our change from the past into a pure single-tenant company, large and well-diversified. So we're pleased with where we are today. And the capital markets, very frankly, have been very helpful to us. During that period of time, we've issued $1.2 billion of bonds and $700 million of equity. Very helpful.
And you mentioned a lot of the acquisition sales that you've already accomplished. Now that we head into 2018, how do you view the portfolio overall? And do you think there'll be a lot more work to do to pare down the portfolio, or will it be one of addition?
We like the portfolio. There's a little change left. We've put very important parameters around the portfolio. No tenant more than 5%, industry more than 10%, geography more than 10%, and so forth. We violate a couple of rules still. We have one tenant, Red Lobster, which is 6.8%. It was 12. We brought it down to 6.8. We'd like to get that closer to 5. We'll do that by the end of next year. We also have parameters around our property types, 15 to 20% for office and industrial. Office is just a little high at 20.3. There'll be a little pairing there. Once we do that, the portfolio will be in really good shape, and we'll feel good about how we move into next year.
You mentioned that the portfolio is focused on the single-tenant retail. How does that benefit the company, and do you think that provides some insulation for some of the broader concerns that people have about retail?
Just to back up, retail is about 40%, restaurants is about 20%, and office industrial each 15 to 20%. So it's a diversified portfolio. To your point on retail, the retail issue is the disruptors that have occurred, most of them online. Amazon, and others. Our 40% retail is primarily discount and service-oriented, so we feel relatively good about that. Always conscious of online, conscious of the disruptors, and we always look at those tenants to make sure long-term they embrace online and they have the capacity to put online in. Those resources are important. That will provide for our tenants to have an omni-channel distribution, so we care a lot about the tenants we have within our merchandise categories.
Glenn, thank you so much for joining us.
Thank you.
For more from REIT World 2017, be sure to visit NAREIT's website, REIT.com.